let's take a look at our questions as they have come in here. All right. I believe David was with us earlier today when we were showing the radioactive trading presentation. And what David wants to know as far as the search tool in a particular strategy, I guess, but in any strategy really, what would I put in to find a breakout above the upper Bollinger Band? Okay, now that's a pretty easy setup to do, actually. You can take any strategy you want, David. I'm going to go ahead and jump into the married put screen, though. Oh, excuse me, David. We're just going to start off with the basic criteria for the married put screen. Of course, there's a position that I opened today, but with a June 65 put in our 12 o'clock webinar, the UBNT married put position. Now, for those of you that might not know, David's asking about Bollinger Bands. And let's just take Ubiquity first here. And I'm going to go to charts. I'm going to go to big charts. Now, big charts just gives you a standard chart view, but over on the left you can customize it based on different indicators. Ernie and I kind of customize our charts the same way, well, because I learned from him. But what I'm going to do is I'm going to set mine to a 6-month chart. Now, I'm sorry, I'm going to go to 3 months to make it more clear on the webinar, but I typically use 6 months. And then over here on the left, I'm going to set the indicators. And on the far left, I'm going to set SMA to my first one. It's 20. A day moving average. The reason I want the 20-day moving average is because I'm going to select the Bollinger Bands, of course. And the Bollinger Bands are based on that 20-day movement calculation. Put MACD as my second indicator. I'll put RSI as my third, and then of course I'll put volume as the fourth as well. Now let's go ahead and draw that chart, and I'm going to take a moment here to store the chart settings. There we go. Just to make sure that when we link to it next. Now, what David is referring to, of course, these two bands, these two orange bands that you can see here on the chart are the Bollinger Bands, the upper and lower Bollinger Band ranges on a stock chart. So that's the upper band, and down here we have our lower Bollinger Band as well. In the middle is the 20-day moving average. Okay? So recently we saw UBNT broke above the upper Bollinger Band here. It actually did the day before. Closed there, continued to move above it, kind of settled back in, but then closed above the upper band today as well over the last 5 days or so. Let's do a 1-month chart, but it might want me to do the time, and I don't think I want to do that. So let's do a 1 month. Oh, fantastic. So there's a better view of the last month. So we can see here we just about closed right at the upper band, and then we did close above it. Stayed above it, kind of settled, but we closed above it again today. So what David's looking for is a screen, a filter you can use on power options to look for stocks that are at any time above the upper Bollinger Band. All right, now let's take a look back and let's go into our technical screen. So we're still in married puts, but this is the same setup for any strategy. Maybe if you're looking to buy long calls, for example, that's actually approach Ernie uses, and I believe there's an article in the Long Call Learning Center on using the Bollinger Bands for buying calls and buying puts. But just with this list here, there are two fields, David, in the technical field for Bollinger Bands. One is the bandwidth. Now, that's the width of the two bands away from each other. And what I mean by that is, let's go back to our chart, the percent bandwidth. So in this range, when it's really tight and it's condensing, it'd probably be about a 5 or 10%. This might be 15% range. But when you have sort of a breakout and those get wider, this increases. So the bandwidth here might be about 40%, 50% or higher. Right here it might be in that 10 to 15% range. So it's referring to the width. The idea being that condensing stocks that are getting a tighter and tighter band are poised for a breakout one direction or other. And something that has a wider Bollinger Band width naturally means that some event occurred or it's been in a movement direction. It has some volatility to it. But we want to focus on the percent BB20. The percent BB20 shows us where is the stock now in relation to the upper or lower Bollinger Band. You'll see there's a description right here. Let me get in there and try to see, sorry. I get in there and try to scroll down a little bit. So it shows here, if you want to filter for stocks breaking through the upper band, we would just put in a range of greater than 100. If the stock's trading right at the upper band, it has a percent Bollinger Band or percent BB20 of 100. If it's trading at the very bottom, on the bottom Bollinger Band, that's percent BB20 of 0. Okay, so you can actually look for less than 0 to show stocks that have just broken through the lower band. If you're looking for bearish positions or bearish breakouts, we want to look for ones that have broken above the upper. We're going to use 100. So I know we only had, 15, 16 stocks, 14 stocks that matched our criteria. But let's go ahead and run the search there. Ironically, there's 2 in the default married put screen that have broken above the upper Bollinger Band. And by luck, but no, actually it's looking at the charts themselves. These 2 positions, AEIS and UBNT, that match the other radioactive trading criterion above the upper Bollinger Band are the same 2 that I opened this week. So there's AEIS, which I opened on Monday, and UBNT, which I opened today during the webinar. Okay, so that's the screen for the upper Bollinger Band there. You just go into technicals. You want the percent BB20 to be greater than 100, and that'll show you positions that have broken above the upper band. Now I'm going to go into long puts. So I don't see long puts available on my account here, so let's go into other strategies. I'm going to go ahead and take out naked put for the time being, cash secured naked puts, and I'm just going to add in long put. Now let me go ahead and save that configuration. And let's go into the long put menu. So if you go into long calls or long puts, David, you'll also see a write-up from Ernie on the Bollinger Bands for long options right there in the Learning Center. And at the same time, if we go into the search itself, one of the default search is, in both long calls and long puts, are Bollinger Bands. So what this screen is looking for, this default search is looking for puts that are at the bottom end of the Bollinger Band. The put is 3 months out to expiration. It's near the bottom of this yearly stock range. It's in a downtrend and greater than 10 contracts for open interest. So we look at some of these positions. I don't know where any of these are right now, but let's take a look at Valiant Pharmaceuticals. That's such a low price stock though. Let's take EQR, Equity Residential Properties. Let's take a look at that chart. And you see here it's kind of broken below, but it's still trailing downwards. MACD crossover is going down as well. This is starting to look like a bad chart. I would check to see where their earnings are though, because I would not want any surprises. But in the long puts, that's especially what we're going to see. We're going to see stocks that have broken through that Bollinger Band, that lower Bollinger Band with this default screen, and going further. And we're looking for less than 5. So they might not be right at 0 or below the lower band, but they're pretty much in that bottom range, and they're trading at the low, their 52-week range as well. So this is a search to help you with puts to buy, but in any search in the technicals field, you can use that percent BB20 to find positions that are at the upper Bollinger Band, which would be equal to 100, or popped above the upper band, which would be anything greater than 100. And then, of course, anything less than 0 would be below the lower Bollinger Band as well. Okay, so that's how you can use the Bollinger Band criteria. And you may want to combine it with other things. You know, might want a stock that's broken below the lower band, but of course has been trending downwards as well. You know, looking for stocks below the SMA 20 in addition to being in the lower range of their Bollinger Band. You may even want to use a MACD where the MACD has been under the signal line for maybe at least the last 2 to 3 days or so. So it's already had that crossover and it's continuing to move down. So you'll get, you know, we already saw a stock chart like that. Let's look at Walmart. I didn't realize that they were having a downtrend recently, but let's take a look. Okay, so they might have had earnings today, I don't know, but they've been trending downwards. I haven't been paying attention to this stock at all. I've been trending downwards over the last month significantly, it looks like, and then they had a decent gap today from 67 down to about 65.50, and they had that crossover and it's been moving down significantly. So that's, yes, we would have liked to have gotten in here, but that's when you can, if you want to see more positions that are in this area or more along the lines in this area, you can use that MACD screen to just look for stocks where the signal line, which is your red line, has crossed, I'm sorry, the MACD line has crossed below the signal line less than 2 or less than 3 days ago. Let's see if we could find one. Rather than looking for ones that are more than 2, let's go back to the search. Okay, I'm going to use a MACD under the cross signal here, down at the bottom of less than 2 days. Okay, so Express Scripts. I already traded this a couple times, I think. Let's go take a look at big charts on Express Scripts. Okay, so there's a recent MACD crossover just about 4 or 5 days ago. Let's go to the 1-month chart again so we can see a better view on that. All right, so there you just had a crossover on the MACD line about 2 days ago. The stock has been pulling down and just did close below its lower Bollinger Band as well. So this is sort of looking like a breakout to the downside, okay? And Sam mentions a double top about on Walmart. Yeah, we could go back to that there in a second too, and you'd see other chart patterns, I'm sure. So let's go back to Walmart. This is the Walmart chart now, and we can go back to, let's say, a 6-month chart. There we go. So peak out, sort of you see the wide Bollinger Band range with the first decline, and then it climbs back up. Significant fall there, and it climbs back up, and then it's been declining since as well. Okay. Oh, and Sam, I just saw your other note that you were actually on holiday out in South Africa. Welcome back, Sam. It's good to have you back for the Friday presentations as well. Okay, so once again, that's how you can use the Bollinger Bands and the percent BB20 to look for positions that have broken out of an upper Bollinger Band or lower Bollinger Band. And you usually might want to combine that with another criteria looking for breakouts, maybe that MACD crossover, or if the stock's still in a continuous downtrend. A lot of times you might get fake signals. Let me think of one. I know I had an example that, sometimes you might have a stock that has earnings coming up, and the earnings are actually good, and the stock has been strong, and the earnings come out and they have positive growth and positive revenue. Maybe they even predict positive growth for the next quarter, but for some reason the stock falls 6 or 7%. Well, it would probably break through that lower Bollinger Band. It would be a signal that it's broken through the lower band. But if you look at it, it's likely an overreaction, and the stock might not stay down there. It might start coming back up. So it would not be a good play to do a bearish position on a Bollinger Band breakout due to an overreaction to earnings. The same is true for the upside as well. Sometimes you'll have a stock that pops up, but it can't maintain that growth, and it pulls back or drops back 50% from where that growth was, and then kind of stagnates a little bit. Each situation's different, but that's why you have to be careful when you're doing the Bollinger Band screen across the universe of options, and you see 3 or 4 that just today broke through the lower Bollinger Band. Well, if you see it's because of earnings, it might be a good bearish indicator, but at the same time, if it's an overreaction, if you go into a bearish play there, the stock might recover 50% of what it's lost, and your position will be at a loss regardless. So you got to be careful with that as well. Okay. Jonathan, I'm sorry, I couldn't tell if it was John or Jonathan. Okay, Jonathan asked earlier, you mentioned, in an earlier webinar, you mentioned the difference between a parity trade of a bull put credit and a bull call debit. What do you mean by a parity trade? How can I see the parity trade? Okay. Well, we have a tool here for those of you who are doing spread positions, and it, of course, is the spread chain. You can access it here on the main menu, or, of course, in the Signature Tools tab as well, I believe. Yeah. So what the spread chain does is it gives you a view using midpoint pricing for the calls and puts, and what it's showing you is sort of here different views. You have the credit spread view, and what the credit spread view shows you is the bull puts on the left side, bull put credit spreads that match some base criteria you put in. These are bull puts, and then over here is the bear calls. And the basic criteria that you can put in, sorry about that terrible penmanship, you can set your spread width, if you want a 1-point spread, a 2-point spread, a 3-point spread, and so forth, a minimum net credit, the range you'd like to be out of the money, the minimum percent return, and the probability range as well. And you can, of course, easily select which date, which expiration cycle you want to look for. Now let's just take Apple for the first example. I'm going to look at spreads roughly 1 week out. Let's just look for February 3rd. Bull put or bear call spreads on Apple. I'm going to want the spread width. They offer single strike differences, so I'm going to want a spread width of 2. I'm going to look for a minimum 10-cent net credit. I'm going to want the short option leg. That's what this percent out of the money range is referring to, the short option leg of the call or the put. I'm going to want that to be at least 1% out of the money. I'm probably going to go 2. I want a minimum return of 5%, and I'm going to keep my probability. Now the system knows that to calculate the bear call credits, it's looking at the probability below. And for the bull put side, it's going to be looking for the probability above. But in either case, it has to be 75%. 75% below or more for the bear call, 75% or above for our bull put. And so let's go ahead and submit that. And let me take out the 21st, and I want to see the 7th. Okay. So again, over here on the left-hand side, higher strike prices, the 125, 127, with Apple trading at 121.95. The 126, 128, and so forth. These are my strike combinations. And on the bull put side, it's 119, 117, 115, 117, and so forth. Now, this is just your straight credit spread view. And this might be useful for someone who's looking to do iron condor positions, because I could say right now, okay, well, the 126, 128 bear call spread has an 88.7% probability of expiring worthless, and I can get a 30-cent net credit for 7 days. At the same time, over here, the 116, 118 has an 88.8% probability for our bull put. Probability above, and we're getting 36 cents. So this might be a reasonable combination for an iron condor. 126, 128 bear call, 116, 118 bull put. But, Jonathan, to your question, parity trade. The setup for a bull call debit spread and a bull put credit spread is different, but they're parity trades because they offer the same risk-reward profile, and when you use the same strikes, you have the same probability of success, you have pretty close to the same monetary return, and the same risk. So here we could look at credit spread view, so we see the bears and the bulls together. We could look at the debit spread view, but I'm going to click on the put credit and call debit parity with our same criteria that we were using before. And let's take our bull put that we were looking at. Here is the 116, 118 strike bull put spread. So what does that mean? It means I'd be selling the 118 put and buying the 116 put. And it shows here that we'd get 78 cents for our bull put, for the 118 put, we'd receive 78 cents, and we pay 42 cents per contract for the 116. So we get a net credit. There's our 36 cents premium. 22% return. So 36 cents against the 2-point spread is a 22% return if the stock remains above 118. Both puts expire, we keep the 36-cent net credit. It's 22% return. And of course, there's an 88% probability of the stock staying above 118 and expiring worthless. Okay, so there's our bull put. Now, on the left-hand side, we see something a little bit different, don't we? It's pretty much the same as far as the strikes. We've got the 116, 118 strike, but what we're seeing here on this side is if I sold the 118 call and bought the 116 call. Well, naturally, since they're calls, we're going to pay a debit or pay a premium of $6.15 for the long call. But we're going to collect $4.60 for selling the short call. So what does that really mean? Well, that means, of course, that we now have a net debit of $1.55. It would cost us $1.55 to enter this position, enter the bull call debit spread. But what happens at expiration? Well, if the stock is trading above 118, which is still the same 88.8% probability, both calls would be in the money. We'd close it out and get $2 back. And so we'd have a profit of 45 cents over an investment of 155, which would turn out to be a 29% return for 7 days. So side by side, these are exact same positions. They both make the same profit if the stock is above 118. You both realize the full loss if the stock's below 116 in 17 days. The 36 net credit you receive on the bull put would put the monetary risk on your position at 164. So you're looking to make 36 cents off of $1.64. That would be the margin requirement, 2-point spread minus the 36 cents. And that's going to equal a 22% return. Still respectable. But here we see if our thoughts are the stock's going to stay above 118, where we don't think it's likely to drop below that, I'd get more bang for the buck if I can get filled at these prices, at these midpoint prices, pay a 155 debit, and then if the stock stays above and I close it out, I'll get 45 cents back because we'll get the intrinsic value of the 2 points on a 155, which would give us a 29% return. Now, it's not always the same, and it's not always the same in each stock. Take a look at the next one, the 115, 117. Here we see that a net credit of 22 cents on our 2-point spread would be a 12.4% yield. But over here, the debit at midpoint is 193, which means we'd only make 7 cents. So it's only a 3.6% return. So it fluctuates based on bid-ask spread as well, and so forth. Okay. Now, all right. That being said, first off, I don't think you would do I don't know if you do a spread on Apple or not. I'm not making a recommendation or suggestion. I think Apple might, if it hasn't yet, I think it has earnings coming up next week. I don't know if they came out this week, but I wouldn't enter a bear call or a bull call or a bull put if I've got earnings coming up in 7 days. But this is the parity trade. The profit and loss chart is similar. The only difference, there's 2 subtle differences that I do have to cover. You know what they are. I just like to point them out. So here's our bull call debit spread. So I can move that over there. I'm sorry, that's too much. That went too high on us. Whoa, there it goes. Sorry, I'm caught in a loop here. Give me 1 second. There we go. So that's the call spread. And here's the bull put. There we go. It's just going to keep messing with me there for a little bit. I apologize. Come on. There we go. Just doesn't, screen's not designed to do this. Okay, so both positions make the full profit if the stock's above 118. Both have the full losses below 116. What are some of the other subtle differences? Well, number one, when you do the debit spread, naturally you pay a debit up front, and in the credit, we receive the credit up front. A lot of investors like to see the credit and see their portfolio increase briefly by that 20 or 30 cents or so, rather than paying the debit outright. The conversation I had with a gentleman yesterday was, well, I like paying the debit. So let's say we got filled at the midpoint here, the net debit at 155. He said, because I know what my maximum risk is. I can't lose more than $1.55. Well, here it's the same. You know, you can't lose more than that $1.54 on the position there if the stock falls. Okay, so it's pretty close here on that view. Was I looking at the wrong one? That's strange. In any case, the oh, I did. How about that? I'm sorry. Let me close that bull put. I didn't realize that I had done that. I need this one. I need the 116, 118 to be a fair comparison. Sorry about that, folks. I was looking at the 117, 115 bull put, and that's why the prices look the same. Okay, so on the net credit, your broker's only going to require you maybe to put up the margin requirement, the 2-point spread minus the 36 of 164. In both, you know what the max loss is. I think the customer's fear was that if the stock fell and went below both strike prices, he wasn't clear that his broker would. Let me put it this way. If I was in this bull put spread and the stock fell below both strike prices, let's say down to 110, and I didn't do anything at expiration, my broker wouldn't just buy shares of stock for me at 118. That is the obligation of the short put, and you might end up owning shares of stock in the bull put credit spread. That is an end possibility, an end game possibility, especially if it's, you know, if it's between the 2 strike prices and you didn't do any management. But if it falls below both, what your broker's likely going to do is just buy shares of stock for you at 118 and immediately sell them at 116. So again, you take the 2-point loss, but you keep the 36 cents. You have a loss of 164. You can't lose more than that. Just make sure that your broker does handle that. What is the other issue? And it's not a big issue now depending on how many contracts you're trading, because there's a lot of discount brokers out there that offer good premiums. But in the bull put spread, which is on the lower one, if the stock's trading above both strike prices, these two puts expire worthless. I keep the 36-cent net credit, and that's it. My margin's freed up. In the debit spread, if the stock is trading above both strike prices, if you do nothing and leave it to expiration, well, you're going to be obligated to deliver shares of stock you don't own at 118, so your broker will automatically buy them for you at 116. So essentially, same transaction if the bull put went against you, but reversed. Your broker might immediately buy shares of stock for you at 116 to cover the obligation of the short call at 118. You still get the $2 back, but what happened? Well, when these expire, there usually isn't a commission. Some places charge a little fee for expiring options. But in this, with the bull call debit spread, if you do leave it open and don't close it out beforehand, they might charge you as much as 2 stock commissions. I've seen brokers do that before. They charge you a stock commission for buying to open stock at 116, and they charge you a sell stock commission to close it at 118. Okay? So if you're doing weekly options with a low net credit and you're only trading 3 or 4 contracts, that comes into play. That extra commission of $8, $10, $15, depending on your broker, that comes into play depending on how many contracts you are doing. Okay? And in any case, to get the profit, regardless, if you don't leave it open to expiration and it is in the money, you still have to buy to close one and sell to close the other to get close to that $2 difference to get the profit. So the debit spread usually carries an extra commission with it for success, and it may be as much as 2 commissions depending on how you manage it. All right, I've got a few questions coming in. Oh, thanks, Sam. Sam says the January 31st is the earnings on Apple, so I wouldn't do any kind of vertical spread on that stock right now. Personal preference. Okay. All right, so James asks, and David, I'll get to your question in a minute, but James is on topic here. He says, what do you use to calculate your target and stop for a debit spread? I pretty much use the stock. Okay, so if no earnings were around, James, if earnings weren't a factor and I opened this bull call or this bull put credit spread, I've sold the 118 strike. Okay, that's my pivot. I focus on this, the pivot. And if it was a bear call, it'd be the option I'm selling. That's my pivot. So what are some of my target prices? Well, that's going to depend on a few factors. My main target for a stop is if the stock reaches within 1 to 1.5% of my short put strike price. So on the bull side, I've got the 118. Well, 1% is about $1.18, isn't it? So I'm probably going to look to close this position or maybe look to manage this position if the stock falls to about 119 or so, $1 or $1.20 plus the strike price of the short call. Now, that's my standard for 2-week out, 3-week out options. This is a 1-week out trade to February 3rd, so I'm going to be a little bit more lenient. I might go half to 0.75%. So maybe 118.60 or maybe 118.70. I know that sounds like splitting hairs. What's the difference between 118.60, 118.70, and 119? Well, on a credit or debit spread, it could be 20 to 30 cents. It is 20 to 30 cents. Does that sound like a lot? Well, my max profit is only 45 cents. Yeah, it's 50% of my maximum profit, so that is a big difference there. But you want to allow it to have some room, especially with the weekly trade, because you collected so little premium. It's a gamble, I'll admit, but it is in fact something you'd want to consider. Now I'm going to enter the bull call was better. Yeah, I'm going to enter the bull call into our portfolio, and I'm going to illustrate this a little bit more for James. So let's add our bull call debit spread, and I'd use the same, what I'm going to show you is the same thing I'd use for a bull put. We'll just put it in here. We'll put it in spread trades, stops. Okay. All right. Oh, sorry, folks. Okay, so we're just going to do, let's say, we'll keep the math simple. I'm just going to use one contract of each, if that's all right. We're going to put that we enter this trade today for our bull call debit spread. I dropped my pen, sorry. Okay, so we know what the profit, let's go to profit and loss chart to get a better view. Here's the profit and loss chart if we enter the bull call debit. The first thing I'm going to do is that one, maybe for a weekly it'd be 0.5 to maybe 1%, and if I'm doing a 20 or 30 day trade out, it's going to be 1 to 1.5%. All right, so I'm going to manually calculate that. I'm going to find out what the price is. Let's say we decide on 118.70, James. So when I go back to the portfolio, in the alerts column here, I'm going to go ahead and click View, and now I'll put in my stock limit. So my lower limit for the stock is 118.75. I don't have an upper limit. It could go to 100, I don't care, because my position is going to be at full profit. I'm going to mark that as a red warning. What are some of the other things you might consider? Well, let's take into this other account. So the first one we have is that one, the percent change, percent to strike price. I don't want to let the stock go more than 1 to 1.5% near the strike price difference. Number two, James, if you open a credit or debit spread, you have some basic criteria that you set in. For the bull call debit spread, it might be just as simple as looking for a stock that's above the 20-day or the 50-day moving average. You might have used the Bollinger Bands, okay? But in any case, what technical indicators you use, one of your alert triggers should be if the trend reverses. So if I found this Apple spread, which again, not going to do because earnings are coming up next week and I don't want to be any directional vertical spread that carries a 5 to 1 or 10 to 1 risk-reward ratio when it could drop down 6, 7, 8% or it could pop up 6, 7, 8%. In any case, James, you may have looked for stocks specifically where they're trading above their 20-day or 50-day moving average. So the technical indicators you use, you'd want to use the reverse. So I'd want to be notified as an alert if the trend reverses and my stock moves below the 20-day moving average or the 50-day moving average before next week for a bullish position. Some investors like to use premium. We saw in our position that we're going to make a max profit of 45 cents if the stock stays above both strike prices. We know our max risk is 155. It's the most we can lose. So some investors might put a stop in at 40% to 50% of the max loss. Okay, in other words, if the stock drops to, if the stock falls and we now have a loss of 0.78 cents, about 50% of the 155, they'd use that as a target to close, basing it on the price of the spread. I don't know if I'd let it go that far personally, and that's why I use the 1% rule, because usually if it falls to this range, I'm still probably I might be at a loss if it happens in the first 2 days or 3 days I'm in the trade. But I don't think it's going to be 50%, but again, that all depends on the stock. Another thing you might consider is the delta if you use that to screen. I talk to investors, power options on a regular basis that use delta for, let's say, their short call premium, their short call they're going to sell in a debit spread being in the money, or the short call or the short put for the credit spread being out of the money. In other words, if I was doing a bear call on the reverse side and I was going to open a bearish position, they might look for only positions where the delta of the short call that you're selling is less than 0.3, which equates to about a probability of 70%, 0.30. So in that case, if I use delta as one of my entries to get into the bear call spread, well, if the delta moves up to 0.4 or 0.5, I'd probably look to get out of the position. A gain of 0.15 in the delta from where you selected it. Or the probability. If I open this position with a 75% probability of higher expiring worthless, and that now drops maybe 15 probability points down to 60, or some number, 55, you might look to change it. Okay, so those are all things that we can set into the portfolio for the change in the price, if the stock drops below the 20-day moving average, if the position as a whole is at a 50% or 60% decrease in its value. Those are some of the, sorry, I'm trying to get back to the arrow. Those are some of the alerts that you can set here. So the time value change on the option, days remain to expiration, of course, the total position change, So if it drops 20% or 30%, and then of course you have the SMA value. So if the stock drops below the 20-day for your bullish ones or goes above the 20-day or 50-day for the bearish ones, you'd set that as well. Okay. In addition to that, as always, we always get a chance to mention this during the webinar, during any webinars, but I'll mention it now. Of course, if you go under the main home tab and click on the free webinars tab, this is actually a public page, www.poweropt.com/webinars.asp. I'll send that to everyone in the chat window there. And if you go here, click on Option Strategies, and there's 3 webinars you might want to check out depending on what you're doing the most. Here from July, Managing Your Bear Call Credit Spread. Oh wow, that is not expanding. That's new. Sorry about that, folks. But this one is 7 ways to manage and adjust your bear call credit spreads that move against you. And it talks about the target points I'd use for a bear call spread, how to set that in the portfolio, and of course, then, once the triggers are hit, how do you manage it? Further down, there is a full one on managing your bull put credit spreads. Very similar. 7 ways to manage the spread as well as trigger points to use to help limit losses. Similar concepts to the Managing Your Spreads webinar. This discusses both, all 4. How to manage credit spread or debit spread, the different ways to use them. I split it up later into a Managing Your Bull Puts and Managing Your Bear Calls here based on customer request. Someone just wanted to see bull puts. They didn't want to see all 4 debit and credit spreads mixed together. They just wanted a full webinar on bull puts, so I did that. Well, naturally, you give it to one side, then you're going to get requested, well, can you do one for bear calls? And so there's a full webinar there on managing your bear calls, okay? All right. Yes, James. I'm sorry. I should have covered that. My apologies. You can't see it here because I'm on a trial account. James's follow-up question was, can I have the results emailed to me? Yes, you can. So let's go back to the portfolio. And I'm showing a webinar trial account. I'm not onto my main account, but as a if you're a subscriber on the 20-minute delayed, the historical, or the real-time service, what you'll see here is a link to have the email alerts, or the portfolio alerts, forgive me, emailed to you. Okay, so you'll have a button there that you can check. You can have those emailed to you, and then once they get sent to you, you can have to reset them or change it, or if you don't, adjust the trade. So yes, it's not available on the end-of-day service. Okay, so the email alert feature is not available on the end-of-day $40 service. It's only available on the 20-minute delayed. Okay. All right. Now, he's been patient. David's been patient. David wants to know, can you talk about a diagonal calendar call, how it works and what happens at expiry of OTM, ITM, and ATM? Okay. A calendar call spread. Now, there's some semantics in this, but just to let you guys know here at when you're asking questions here at Power Options, he asked the correct question. There's different forms of what is called a calendar spread. There's 3 main forms of a calendar spread. There's a diagonal, and then there's the straight calendar. And there's 2 different diagonals. I call it a standard diagonal and a reverse diagonal. Let me take this Dunkin' Donut Brands position here without even looking at it and discussing it. We're just going to take a look at the profit and loss chart. What I meant by discussing it is I'm not going to look at, I apologize, I'm not going to look at the criteria on it. This is not one I would likely do, but let's just take a result. Here, a standard diagonal spread is a calendar spread, but sometimes called a diagonal or diagonal calendar, is when we buy a further out in time in the money call and sell an at or just out of the money near-term call against it. All right, so what we're looking to accomplish here, I'm going to go back and change the criteria in a minute, but what you're hoping for here is short-term option decay to help lower the cost. Now this one is a far out in time diagonal spread. I'm buying a January 2018 47.5 call for 720 and selling a near-term February 55 call for 35. You've got a maximum profit, and that occurs if the stock's trading right at the short call strike price. Why? Because as you start going up from that, you're hedging, you're canceling any positive gain you're having on the long call because the short call goes immediately to a delta of 1 at expiration. So for every dollar that the stock's now moving up, you're giving a dollar back to the delta of the short call, but the long call has yet to reach a delta of 1. It's that magic at expiration. What do I mean by that? Let's say that you and I were looking at Dunkin' Donuts today, and let's say it just popped up $1.82 to be trading at 51.82 here. So just today it moved up $1.82. Well, the delta of your 50 call had gone to 1 because it's at expiration. It probably jumped right to 0.99 and then went to 1. That's the 50 call for this week. However, the 50 call for February probably only has a delta of 0.5, or now probably 0.57, 0.58. The delta for the June or the January 50 call is still probably only around 0.56, 0.57. Okay, so as this goes higher and higher at expiration, you gain no more positive delta on the stock, and although your long call is still gaining in value, this went to a delta of 1, so it's not near 1 yet, and you're still losing that battle. And that's the difference, okay, because the short one triggers. Gets complex because we got to deal with 2 expirations in our mind. Now, another tricky thing about the calendar spreads in themselves. Here we see we'd have a debit of 685. I didn't check this one, but it was on the search results, so I knew it would exist this way. I'd buy the 47.5, sell the 55, so I have a 750 strike difference. That's good. Okay, and why is that good? Because my debit's only 685. And these spreads, you always want to make sure that your net debit is less than the difference in strike prices. Why? Because if the stock suddenly gaps up overnight to 60, and Monday it opens at $60.20, you might get assigned early. And if you get assigned early, your broker might see that, you know what, you don't have the funds to deliver. They don't want to short shares of stock for you. You don't have the funds to deliver, to short the position or the level of approval, which you would have anyway. But they'll look at it and say, oh, well, we're going to buy shares. We're going to exercise your January 47.5 call, buy shares for you at 47.5 and sell them at 55. So you're going to get 750 back. Well, that's okay. You still have a profit, right? You'd have a profit of 65 cents. Okay, so if that's the profit, how are you seeing a max profit here of 217? Well, it's because of the way the options work. At February expiration, yeah, this is February 17th, I'm sorry. At February expiration, if Dunkin' Donuts is trading right at $55 per share, this long call is going to have $750 worth of intrinsic value plus 11 months of time value remaining as well. It's going to be of higher value than exercising the long to deliver the short. In all cases with calendar spreads, diagonal spreads, you never want to let your broker exercise long to deliver the short. You want to be in a position where you can sell to close the long option and buy to close the short option to get the maximum profit. So let's say the stock was trading right at $55 per share. When we see here, the theoretical value of your January call would be 902. Okay? And so that means what you could look to do is you've made $1.82 on your long option and your call expired worthless. You sell this for 902, had a debit of 685, your profit is 217. If the stock went up to 56, what would happen? Well, the long is going to continue to gain in value, but your 55's call is going to go to a value of $1. It's going to go right to a delta of 1. So it would cost you $1 to buy to close the short call, but you could sell to close the long for $9.76. You're making $1.91. Why is that important? Because if the stock went to 56 and your calendar spread was in the money, if you didn't manage it, if you didn't close it, then what would end up happening is your broker would likely buy shares of stock at $47.50, sell it at $55. You get $750 back for the difference in strike prices, but again, you paid $685 initial debit. So, allowing that to be exercise assigned, again, you only make 65 cents. Almost 3 times less than you get by taking advantage of that remaining time value in your 47.5 call. Even if I bought to close this at $1 and sold to close this for $9.76, but even if I had to buy this back at $1, I'm getting a higher profit, almost 3 times the profit than if I let my broker assign it. But again, it can happen at any time, David, in a calendar spread. If this, again, gapped up to 60, I might get assigned early. That's why it's very important when you're setting up a calendar spread, you want the net debit to be less than the difference in strike prices. Okay, to me, this is a diagonal spread. It's a debit diagonal spread. Some investors play reverse diagonal, okay, where they would maybe buy the 60 call for January and sell the 55. Okay, well, I don't like doing that too much, but you can do that and you might be able to get a credit. So let's take a look at a different spread. We'll stick with Dunkin' Donuts. This is not something I do, but sometimes investors might be referring to this. So again, I still want to be out of the money because the obligation of the, and let's take the 55. That's where we were, right? We could take the 52.5. It's probably more what I do, but I'm going to stick with the 55. But let's go out to September now instead of January, and I'm going to buy the 60 call. What's my bid there? 75 to 130. Okay, so it's about a 55-cent difference, of course. So let's just call that 30 midway point. So we'll call it 105. So I'm going to buy the September 60 at 105. And we're going to sell the 55 at 40. Excuse me, folks. There we go. Okay, now here's why I don't like this. You're using calls to get you got a lower debit, 1/10 of the debit that I had. Okay, so it's a what I call a reverse diagonal, and this is how double diagonals are built. It's usually reverse diagonal call and then a reverse diagonal put, so it looks like a broken down and sort of losing its strength iron condor. That's the typical double diagonal, little bat ear thing going on there. It looks like an iron condor, but it's curved because time value. All right. The reason I don't like doing this is because I'm using a call. It's more of a bear call credit spread, but I'm not getting a credit. It's a time debit spread. It's a diagonal spread because the strikes are different and further out in time, but it's more of a bearish play, and it's not even a good bearish play. You know, I like the other way better, especially if I'm bullish. And so you'd say, oh, well, if you're bullish, you would do a reverse diagonal put. And no, I'm sorry, if I'm bearish, I'm just going to do a diagonal put spread, and if I'm bullish, I'm going to do a diagonal calendar call. I just want to keep it simple and not get it confused. Just because it has a lower debit, which does equate to a lower risk, I agree, but it usually puts you in that position with 2 ways to lose. All right. Okay, so that's where it gets complicated. You talk about iron condors. What are the benefit and risk of the iron condors over a bear call or bull put? Well, it's kind of the same as what is the advantages of a double diagonal versus just a calendar spread, one direction or the other. All right, so let's go back very quickly. Let's just input our original spread on Dunkin' Donuts and very quickly talk about your 3 scenarios, and then I'm going to talk about the settings. We already kind of saw this, but what I'm going to do, without knowing what the outcome is here, oh, there's our Dunkin' Donuts spread. I'm going to change it. I'm going to go to the February 52.5, and there's probably earnings coming up on this, so again, it's probably not something I might do with a directional one. But we're going to sell the February 52.5 at 115. We're going to do one contract. We're going to sell it at 115 is the midpoint there. Yeah. Okay, so it's now a 5-point spread. But see, I just contradict myself. I would not do this. Contradict myself. I would not do this because the debit's 605. It's not worth it. To me, it's not worth it. That's why you get the double break-evens. I want the debit to be less than the difference in strike prices. So I'm going to go back. Even though it's so far out of the money, we'll talk about that in just a moment, folks. So we're going to sell this at 40 at the midpoint. Okay. Good. Now, what are the outcomes of this position? Well, you asked for how it works if it happens at expiry, if it's out of the money, in the money, and at the money. At the money is the best case scenario. Plus or minus 0.5% is the best case scenario. Why? Because as we already saw, that's where the theoretical value of the long option will be worth the most before the delta of the short call starts to counter it as it goes in the money. Okay, because remember, once it goes a little bit above this, that delta goes to 1 as you get close to expiration. So you don't gain anything more. That's why it starts to slope off. But at this point, that's where the maximum value is. The call expires worthless, and you have the maximum 7.5 point difference between the strike prices. So that's the peak. That's the good thing. That's at the money. That's what you want. Calendar spreads, in this case, we could say that this calendar spread, excuse me, David, is a bullish strategy. Yeah, we're right here. Stock's at 51.82, which is pretty close to our break even. It's above our break even. But yeah, to maximize the profit, we need the stock to move up to 55. This is bullish. But it's also neutral because I don't want the stock to go too far above 55. I like to kind of stay right around it, right around that price. What happens if the stock, if it's out of the money? Now, what's out of the money? Okay, well, let's say if it's between the strike prices. Hey, no problem. Kind of. Let's say the stock's at 52.5. What would happen? Your 55 call expires worthless. That's gone. You keep the 35 cents. You still own a 47.5 call with a cost basis of 680. So what do you do now? The stock's at 52.5. Maybe you sell a 52.5 call for March. Maybe you sell a 55 call for March. You're treating it like a covered call now, but except for owning the stock, you own a call at 680. Okay? So if it falls and your call expires worthless, that's okay. You would keep writing against it. Would you have a profit? Let's see. We'll use the theoretical again. What would happen if our stock was trading at 52.50, below the short call but still above the long call, February 17th? You'd have a small profit of $48. Theoretical value here would be $7.28, and you keep the full 40 cents. So you make an $8 profit here, you keep the 40 cents, $48 profit on your position. Okay? Not bad, but not great. So would you write again? Sure, you could write again. Now, what happens in the worst case scenario, which is why you'd like to go a little bit in the money, why I don't do what are called horizontal or calendar spreads. To me, there's those two spreads. A calendar spread is any form of diagonal or a horizontal. Some educators and some brokers will say a calendar spread is the same strike spread with different months. I don't like that. I say that's a horizontal, and what we're talking about is a diagonal, in my opinion. All of them are calendar spreads. Okay, you're doing different series. Just so if the same strike, it's to me a horizontal. In any case, what would happen in the worst case scenario if the stock, let's say, had a disastrous earnings coming up and it dropped down to $46 per share? Well, your 55 is going to expire worthless. We know that's going to happen. And now we start to get hurt. Why? Because remember, if the stock falls 10%, and in this case $5, right? If this stock fell $5, 10% of its value for a bad earnings, you're losing 50% of what you invested in the call. That's the lie of leverage. This is where people get hurt buying calls and buying puts because they put too many contracts in. So let's say, oh, for example, here's a bad example, but here's an example nonetheless. I only have $5,200 to invest, but I don't want to buy 100 shares of the stock because I don't want to have all my eggs in one basket and risk $5,200, right? So I only have $5,200 to trade or open to trade. And I don't want to buy the stock because I'm worried, hey, if the stock fell 5 or 10%, I'm going to lose 5 or 10% of the position. And they say, well, hey, I can get into this diagonal spread for only $680. So I tell you what, let me go ahead and, I'll do half of this. I can invest with half of the cash I have left and open multiple contracts. So let's invest $2,600, which would, not quite, but they would allow us to do, let's say, 4 contracts of this position. Okay, so we open 4 contracts. This spread puts us at about $2,700 or so, a little bit more than half of the $5,200 we had to invest. And we've got $2,300 over here in safety. Okay, stock falls 5% down to $46 per share. What would I have lost on the stock? $600. What would I have lost on the 4 contract diagonal spread? Half of $2,700, $1,850. Wow, my math is terrible today, folks. I apologize. Whew. Wow. Okay, so let's say $1,350. Let's get the number right there. Be $1,300 roughly and $1,350. So, you see where I'm going with this? If you had just bought the stock outright and it fell 5% to $46 per share, or 10%, I'm sorry, to $46 per share, you'd have lost $600 owning the stock. Leverage works both ways. So if you've invested half of what you could have invested and put $2,700 into 4 contracts, stock falls 10%, you're looking at that 50% drop, $1,350, more than twice what you've lost of owning the stock outright. You've got to remember that the leverage works both ways. You don't want to overtrade this position. I'm also not telling you to just open one of each call when you're opening the diagonal spread, because if you get the profit, it might not be monetarily worth your while for just one contract. But you've got to pay attention to the lie of leverage that works both ways. This is the concern. There's 2 concerns with calendar spreads. Number 1, the sudden gap up, you could be assigned early. That's why you always want to make sure your net debit is less than the difference in strike prices. Number 2, the downside, the lie of leverage. You have to be careful with that. We saw here that the long call is losing about 50% of its value if the stock drops 10%. Okay, and this is your investment now. The stock's not your investment. This value of the long call is your investment. You have to practice proper position sizing or you can get hurt. So that's the lie of leverage. It works both ways. Now, what are some of the dangers that can happen otherwise in the spread very quickly on a diagonal spread? Let's say the stock fell to 50. Not too bad. Your 55 expires worthless. You only collected a little bit of premium anyway. And you decide now that, let's say the stock falls to 50. This expires worthless. So what happens? Well, your cost basis goes down to $6.80. Here we are at February expiration with the stock at 50. Dunkin' Donuts only offers standard expiration. And let's say we could sell the March 50 at that time for maybe another 50 cents. Okay, so low premium, it's a low volatile stock. Okay, but now you rolled it down like a covered call. What would I do if I was in a covered call in Dunkin' Donuts? I sold the 55 call, it fell down to 52 or fell down to $50 per share or below it. You'd let it expire and then you'd roll down, or you'd roll it down, excuse me, sell the lower strike call to hedge down your basis. So you're trying to lower it. Do you see how quickly that hurts you? Take a look at that chart. What happened now? On February expiration, let's say Dunkin' Donuts is trading at 50 and we could get 50 cents. We could even say 80 cents. It doesn't matter. And I'll put 80 cents in to show you that it doesn't matter. We could get more. Someone commented, well, wouldn't it be worth more 80 or 90 cents? Not on Dunkin' Donuts. It's got a low volatility. I traded this for a year. I know kind of how its premiums work. But look what happened now. You rolled down to still try to effectively lower your cost basis, but now what happens, okay, and that's not where the stock is. Let's say the stock was here at 49.70, 49.80. Now what happens if the stock recovers? You had to roll down to get a reasonable premium to keep lowering your cost basis. It's just like the effect of a covered call. If you roll down and try to chase a falling stock with a covered call, if it recovers, you probably locked yourself into a loss because the call that you sold, the strike you had to sell to get a reasonable premium, is well below the cost basis. Same is true with the calendar spreads. You almost want to think of this, David, as a covered call, but you're playing 2 new dynamics. You have 2 options with different expirations, and your friend is the time value swelling and the slowness of the time value decay in the long option, in addition to the rapid time decay of the short option, which you get with your covered call. So, quote unquote, chasing the dragon or following it down the rabbit hole and rolling down and rolling down and rolling down, you have to be careful, because if it recovers, you might lock yourself into a much higher loss. Why? Again, because the difference in strike prices now are much less than your net debit. We've got a $6 debit and a $2.50 strike difference from the short and the long. Okay? Now, so that's what you expect to see. At the money is what you want. You want it to be right at the short call strike price at expiration as best as possible. If it moves up, you want to make sure you put yourself in a position where you have that wider upper break even, and that's usually achieved by making sure your debit is less than the difference in strike prices. Remember when we sold the 52.5 for the higher premium? In this scenario, we would have gotten 115. Well, my debit's 565. My strike difference is 5. So now you've got an upper and a lower break even. If the debit is less than the difference in strike prices, you'll rarely see this. Okay. Okay, now what if it goes in the money again? You know what happens? You start to give back the premium. You're going to treat this short call on your calendar spread the same way you treat a covered call. So I'm typically selling at or slightly out of the money, and if my short call, if the stock starts to move up, my short call is in the money, I'm going to roll this 52.5, maybe up to the 55. If you're single strike spreads, you might just move it up 1 or 2 strikes. You're going to treat that as a covered call. It's going to affect the dynamic of the position. If you roll for a debit, that would increase the cost basis on the position, but you don't necessarily want to get assigned unless you're happy with this profit. Okay, that's another thing you have to do when you analyze the charts. You have to be comfortable saying that, okay, I'm happy with this profit area. Yes, I know my maximum profit is here, but I'm happy with this $80 profit on this 565 investment if the stock goes to 56 or if it pulls down to 52. You also have to have another plan. Are you trading this to get this return hopefully every 30 days? Meaning, are you just entering this position because you want to target this strike, hope to get that return and close the position? Or are you looking to use leverage to treat this as a covered call and continue just to sell calls against it month by month by month? You got to develop kind of that trading plan, David, with the calendar spreads, because you want to decide if you're going to be rolling month by month by month, or if you're going to be able to get near to close the maximum return you'd want each month or each time you sell the position, and is that going to be good enough for you? Okay, so there's, just like in a covered call, same thing. You may have heard me say that when you're a covered call, there's a couple types of covered call traders. The out-of-the-money covered call trader is typically trying to hold stock long-term and wants to generate a dividend-like income on a month-by-month basis. They're going to continue to sell calls, hope it expires, and do it. Why would anyone sell an in-the-money covered call? Well, it's because they can still make a 1 or 2% return for a 20 to 30-day period, maybe 2.5% return for a 30-day period. They're not married to the stocks. They don't care. What they're looking to do is have a high probability of getting assigned, being done with the position, that particular stock, in 15 to 30 days, taking the 2% return, and then opening new positions. They're not loyal to any stocks. They don't want to hold any stocks. They're going to just allow positions to be assigned, much like a spread trader who wants all of the positions to expire worthless. So this is an assignment. This isn't in the money. What you're really doing is the second part of the covered call. You're doing sort of out-of-the-money covered calls, substituting it with a leap to try to collect a month-by-month income. Or are you just saying that you think you're going to pick calls that are right at the money, thinking the stock's going to stay right at that price? This is not at the money, I know that. Right at that same price, and you're going to try to get in this maximum return range or this box return range every 15 to 20 to 30 days, and just close the position and then open new positions. I can't tell you which one's better. You've got to develop that plan for yourself based on how much trading activity you want to do, how much you want to watch the stocks, for example, and things of that nature. But those are your outcomes. The graph shows it to you. You give up here if the stock keeps going up because your short call delta goes to 1 and your long call delta is not there yet, right? And that's the magic of expiration. Right at the money is the sweet spot. If it's between the strike prices, hey, that's okay. Short call expires. You may still be at a profit. You could choose to liquidate the long call at that point or just sell a new call against it. And then below that is where you have to be careful due to the lie of leverage, where if you see a 10% fall in the stock, you can lose 40 to 50% on the long call. If you see a 15% drop, it gets more steep. You might be at 60 to 70% loss on the long call. Okay? Now, hopefully you also picked a target that was far enough out, so if that does happen, if you think the stock's going to recover, you have time to manage it. But again, treating it as a covered call and following it down the rabbit hole, chasing the dragon, so to speak, if you roll too far down because the stock fell too much, remember, if it rebounds, you might be locking yourself into a loss. Just as you would with a covered call if you kept rolling down and rolling down as the stock's falling, because you're always going to lose more on the stock than you're going to gain on the short premium. Same thing here. This doesn't solve that problem, by the way. If the stock's falling, you're always going to lose more on the long call than you're going to be gaining by rolling down to lower strike prices on the short call. It's just the way the options work. Okay, the leverage is going to work against you. These premiums are going to be dropping too as the stock continues to fall. All right, so I think that about sums it up. One more thing I want to show you real quick, and if anyone has any last-minute questions, go ahead and send those in because we are a little bit past 5:30. I want to make sure we wrap up at a reasonable hour. On the calendar spread search, David, let me scroll down below the trades. You want to set your time frame for what you want, of course. This one's just set for standard. If we wanted to go closer in time for our leap or our buy option, let's go all months and let's go 90 to 290 days, for example. Okay, so we'll see some 3-month and 4-month out options against the near-term options. If you want to be right at the money with a short option, you know, we're forcing it to be 0% out of the money with the default criteria. Maybe just go 0 to 3%. And you can adjust the in-the-money range for the long option too based on what you'd want to see. Now, I'm just playing with some numbers here. That's, yeah, see, here's one at 90.03. Dr. Pepper Snapple Group selling the 92.5 for 70 and buying the May 85 for 670. But the most important thing, in my opinion, delta ratio is something you might want to consider as well. This filter here, when you're doing the diagonal spreads we're talking about, I put it there in the defaults for a reason. You can take it out if you want to. But the debit to strike difference ratio of less than 1. This assures that any spread that comes up in that trade, the net debit that you're paying is going to be less than the difference in strike prices, less than 1. So if there is that sudden gap up in price and you're risking getting assigned early on the calendar spread, you'll still make a profit because you'll get more back than what you paid in. Many spreads exist where the debit is greater than the difference in strike price, and if you get assigned, you're locked into a loss if you're assigned early. It doesn't happen a lot. I just prefer not to take that chance. Okay? All right. That's about what I have to sum up right now for the calendar spreads. For that discussion, I'm a fan of the diagonals. I'm not a fan of the horizontals or the same strike spreads, but I do have default searches created for you. Those of you who like to do horizontals, this is default search here for same strike spreads. And you're probably going to stick with the initial values screen here, but maybe make 1 or 2 changes on it when you're getting ready to do a search for the calendar spreads. And then, of course, you can set the time frame to your needs, the return for your needs, things such as the delta ratio. It gets confusing. One last little quip here. Quip's a terrible term. I don't know why you said that, but let's go back to Duncan one more time. One of the things that intrigues me about calendar spreads and why I still trade them with about 15% of my portfolio to 20% of my portfolio, depending on what's going on with my other portfolio positions. Now, it keeps changing right now. It had another update, but look here. Here's our spread again, the 55, 47.5, and we're showing this the stock's trading at 55. We can expect a $218 return. This is a little bit different than other positions, with the exception of long calls and long puts, where it could be 218, could be 210, it could be 195, it could be 300. Okay. It sucks, but it's a guessing game because the best we can do is use the Black-Scholes and other pricing models to calculate what would this long call theoretically be worth if the stock is trading at any of these prices at expiration. We see the best is at the short strike price. Any calendar you build, the best scenario is if the stock's trading right at the short call strike price at expiration. Again, why? Because once it starts going up above that, your short call goes to a delta of 1. Your long call is not there yet. It still only has a delta of 0.8, so you're losing more as the stock continues to move up until your long option eventually gets to a delta of 1. Then you're not gaining or losing anything. All right. But that is the target price. But this is based on the theoretical value of this 47.5 January 2018 call if the stock's trading at 55 at February expiration. What can change? Well, the volatility could shift. It could drop, in which case this would be worth less. It could go up, in which case this would be more. What else can change? The bid-ask spread the market maker wants to set. You know, he could, right now this might only have a 10 or 15 cent bid-ask spread. For whatever reason, we hit February expiration. If he set this January option to an 80 cent bid-ask spread, well, we might not get 218 now because we've got to fight for midpoint. We might only get 208 or 198. Okay, because this is based on a theoretical calculation of what the long option would be worth. What is the one thing that we know about this spread because we set it up properly? Is that even in the scenario where we get assigned early, if the stock gaps up, we miss the upside, of course, but if the stock gaps up, we get assigned early, we should still be able to make a profit because we'll get $7.50 back in the worst case scenario. What do I mean by that? The worst case scenario, anywhere above 55, if we just forgot about the trade, we're going to get $7.50 back and we paid $6.85. The real worst case scenario is you're risking 100% of whatever you invested into this position. The lie of leverage takes hold. We saw in this position how a 10% drop in Dunkin' Brands would result in about a 50% loss on the position as a whole. And if it dropped 15%, we'd probably be looking at a 70% loss of whatever we invested in these contracts. It's a lie of leverage in reverse. So, okay, just wanted to point that out there. It's always important to remember that you can screen for a percent return, of course, but the percent returns for the calendars are based on a theoretical value, what the option should be worth. The stock's trading at a certain price based on the current volatility of the option, the current implied volatility of the option, I should say, and other factors. Those factors change in a 1 month or 2 month time period. The option could be worth more, it could be worth less. Unfortunately, let's be honest, for us as investors, it's usually worth less because we wanted it to be worth more. All right. Well, ladies and gentlemen, I don't have anything else, and I didn't see anyone else ask any further questions. Just want to remind everyone, those of you that are online, if you haven't done so yet or you're not currently subscribed, remember you can test drive Power Options for 14 days. Just go to powerop.com, put in your first name, last name, and email address, and you'll have access to the site for 14 full days. Use the search tool, the portfolio tool, and of course the custom spread tool and the search tools that we showed today as well. All right, but if you think of any questions later on, just remember you can send us an email at any time to either support@powerop.com or questions about radioactive trading. You can reach us at support@radioactivetrading.com. And also remember you can reach us during market hours at 302-992-7971, and there's contact links at the bottom of every Power Options page. Thank you once again, ladies and gentlemen. Have a fantastic weekend and a fantastic evening. We'll see you next week for some of our other live presentations. Take care now. Good night.